What's up, guys? Welcome back to another episode of Behind the Facade. I am your host, Gavin J. Gallagher, and on this podcast I explore the mental and emotional game often playing out subconsciously in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset, your behavior, to take control of your thoughts, your emotions, and most importantly, your ego. So here we are on episode 58. Last week I was speaking with Joe Doyle, and we covered Joe's story from starting out as an apprentice bricklayer all the way to today, where he's managed to kind of accumulate a portfolio well into the multi-millions, and he's aiming for 100 million. So that was definitely a popular episode and one you're going to get a lot of value out of. So I certainly recommend you go back to episode 57 if you haven't listened to it already. It is online to become one of our most popular episodes to date. Before I introduce this week's guest, I want to plug two things. First of all, my YouTube channel, as always, Gavin J. Gallagher. If you could go in there and just subscribe, watch a couple of the videos, leave some comments, I'd very much appreciate it. I'm going to put a link in the show notes, and I'm going to tell you a little bit more about the mastermind program. And first of all, some updates on that. I am aiming for a launch of that on the 5th of July, so that'll be Monday, the first sort of Monday of July. And I've kind of come to the decision that I'm going to run this program for 26 weeks. So it's a full 6 months with me kind of basically teaching you everything you need to know about the real estate thing, going into a lot of detail. There'll be 26 modules that you actually get to watch, kind of like a video, and the video will take you for a good hour or more into real detail in sort of one aspect of the property market that I think you should know in detail. And then later on that week, you're going to spend an hour and a half to 2 hours with me on a Zoom call where we go into either questions that people have about the module that was given out earlier in the week, and then we'll also start doing deal analysis. So this is going to be more appropriate to people who have actually got a couple of deals already done and they're in the process of doing one, or they're putting together a deal, or whatever it might be, but it's probably for a more advanced person. And what I'm going to do is I'm going to make the actual the modules available as a program that you can buy and just watch separately. So you have two choices. You can have either the modules, the 26 modules that you can just download and buy, and you can kind of binge on them and just watch them whenever you want. Or you can actually do the 26-week program with me, where you're working with me on a kind of weekly basis for a couple of hours, going over your deal, analyzing your deal, giving advice on how I would go about approaching investors, whatever, finding tenants, all of that kind of detail. So one is just simply kind of download and watch yourself. The other is the download and watch plus the implementation. So it's going to cost more, obviously, because there's far more time involved, but it's probably for somebody who is interested in actually rolling up their sleeves and doing it on a deal. So let's get into our guest today, shall we? It is Mr. John Penquet from Wales in the UK. Now, John comes from a retail insight and data analysis background. And so he has brought a very different set of skills to the property investment process. And where many of us, including myself, have often gone on gut instinct and decided to buy just because you like the feeling of it or whatever. And there are others who are more like lemmings, and they just follow the crowd and they buy because somebody else did it and somebody else, made some money on it. And so, geez, I'll probably do the same. And so they just follow without doing any fundamental analysis. They don't look at the underlying data. They don't do any of that kind of stuff that is very important. Now, this kind of data analysis and just kind of getting inside the deal, doing your due diligence, all of that before you've actually bought is super important, because it'll quieten down all the emotions. And if you are like me and you have that whole gut instinct thing going on, actually having the discipline to sit down and analyze the data is a good thing to do as well, because if you do that analysis, it'll just mean that you have double, your gut instinct is telling you yes. If the data also says yes, then it looks like a great deal. But if one is conflicting with the other, then you need to kind of dig a little bit deeper before you press the button and buy. It'll also give you a lot more confidence in that you're making the right decision. And anyone who's starting out in this game will know that the confidence piece is actually very important, because a lot of the time you'll sit there not willing to kind of make a move, not willing to actually push the button because you're not sure and you're not confident that you're making the right decision. So be sure to check out the show notes today, because John is giving away his book for free to anyone who clicks on the link and follows through. All you need is to pay him the post and packaging coming over from Wales. And so, look, that's it. There's a couple of other links as well I'm going to put into his website, and he's got an online workshop where he shows you how to do the stuff that we're talking about today. So have a look at the links in the show notes for all of that. All right, without further ado, my conversation with John Penquet. Mr. John Penquet, welcome.
Good morning. How are you, Gavin?
I'm very good, thanks, John. Tell us where you're calling in from today.
Calling from sunny Wales. It's one of our small number of sunny days that we have allotted to us in Wales. It's not often sunny, but today it's a bright day, so I'm in a good mood. The yellow thing in the sky is glowing, which is nice.
You mean you can see it? Wow, that's good.
I know. It's incredible, really, isn't it?
Yeah, we've had a rough winter, and I can remember at the beginning of May looking at my phone, and it said it was -1 or something like that, and I was thinking, what kind of country do I live in that it's -1 in the middle of May? It's crazy. Anyway, John, I want to get into our discussion today. I've read your book, which is great. We'll give that a little plug a little bit later on, but just for the purpose of introducing you to the audience, can you just tell us briefly what it is that you do?
Well, first and foremost, I'm a property investor. I've been investing in property for quite some time, well over 10 years. But what I tend to do now, and what I've done pretty much from the start, is I use data and information technology to help me and to help other people to buy high performing properties, the ones that perform better than the average. So that's a large amount of my time is spent on that at the moment, and I absolutely love it. It's really exciting.
That's brilliant, and it's something that I haven't heard a lot of people talking about. So it's one of the reasons why I wanted to have you on today, because there's a kind of there seems to be in property circles that somebody says, oh, the market's booming, and they kind of mean that as in the entire market is booming, and so you should just be out there buying. But you push back on that, and you talk about using data to become kind of very targeted and become like a sniper and pick specific locations. Can you tell us a little bit about how that system works?
Yeah, sure. Well, I mean, the thing that I started out with when I first began investing in property was avoiding risk. So I have a background in insights, retail insights, and I work right through that industry in all different roles, advising and providing reports and information and insights to make informed decisions. And I thought, well, if I'm going to spend a large amount of money, certainly at the time when I started, a large amount of my own money on an investment, I want to have an idea of how it's likely to perform going forward. And if it is going to perform badly, obviously I don't want to buy it. And if it's going to perform well, I do want to buy it. It's simple. But there wasn't really any data out there. There really wasn't anybody that was showing or educating or teaching people how to do that. So I had to kind of teach myself how to do it. And because of that, that enabled me back then to buy properties that were less likely to perform badly, more likely to perform well. So that enabled me to grow and expand and get to a position where I was obviously able to leave corporate world, do some things that I wanted to do with my life, and also latterly, or more recently, I should say, actually share that information with others. But it all started with me avoiding the risk of it being a poor performer. And focusing on increasing the likelihood of me finding a high performing property. It doesn't matter where. I could have done it anywhere in the UK, anywhere in the world, really. But just understanding, what is likely to cause the thing that I'm buying or I'm controlling to change and become of more value. And that's basically what I've worked to do and what I talk about a lot.
That's an interesting one. I mean, can you just give us some specifics around? I mean, let's just take a standard property in the UK. I mean, there's obviously, it's a big country, there's a big population. What kind of data would you be looking at what would be the first, say, 3 places that you go to for data?
Okay, so the main thing that we all need to understand, is that the property values are determined by demand. So the first piece of data, the first piece of research that I always work on, and I work with other people on, is understanding what demand looks like. Now, you've got a bit of a choice as a property investor, and we all seem to approach this choice and go in a particular direction. You can either do the research yourself, or you can ask experts for their opinions. And unfortunately, in our industry, the vast majority move more toward the asset experts for opinions. And that could be someone who provides property training, a large property portfolio owner. It could be the estate agent. But what we have to be aware of is that there's always a risk in that it's kind of out of date, or it's skewed by someone's opinions and someone's emotions and someone's mindset as well. So
and their motivation as well at the end of the day.
I mean, estate agents is the best. I mean, how many people do I encounter every week who hear what the estate agent says and just accept it? I mean, these guys are commissioned sales enterprises that are looking to get your business. They're going to tell you what you want to hear in most instances. So, so I always try and move people away and actually look at, do some demand forecasting ourselves. And that can be as simple as, I don't know, going onto one of the search portals and looking at where the rental prices are moving. So rental prices going up or going down. And how many properties are listed and how the listings are changing. It sounds very basic, but that was that type of analysis, that demand forecasting, really helps you to understand where the market's likely to be moving forward. And we scale it up in Ultimate Landlord and the research that I do, but it's very much all geared around, or sort of orbits around the same principle of, is there demand in a particular area? The second thing that I would encourage people to do is look. Don't just look at one area. Look at the whole area, or the whole area in which you're prepared to invest in, and that could be the whole of the United Kingdom, and it could be the whole of a particular postcode area or the whole of a particular county. It doesn't really matter. You determine what your scale and where you're prepared to invest. However, when you do the data analysis, you need to compare at a very, very finite level. So, from my experience, I've found locations that are maybe just a mile or two from one another where there's a vastly different level of opportunity, a vastly different level of growth. And if we all take a step back for a moment and think about what goes on around us, we see this day in, day out throughout our lives. Whole markets don't move at the same rate. Prices don't all move at the same rate. They vary depending on external factors. The most obvious one in property is demand. So we can see that. We can also see things like average household income. Now, as we're chatting today, we've just come out of, or we're still dealing with the aftermath of coronavirus, and it's drastically changed the sort of employment landscape and the business landscape in a way that I could never have imagined. I don't think any of us could have. Now, that change will require the market to change as well. And people talk about, market's getting overheated, it's not working very well, blah, 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 or it's 11% up. Well, it's brilliant, yeah, but it's not the same everywhere. Some locations are seeing significant growth. Some locations are seeing relatively averaging sorts of growth, and some locations are not seeing growth at all. In fact, there are locations, as we sit here right now, in a market that's growing at sort of 8-9%, there are locations that are actually in decline.
I've seen that here. Actually, there's been a report in Ireland that the general market is kind of running away. It's on fire. But in Dublin itself, there's actually been negative growth in rents and stuff like that. So it's interesting. And what would you say? I mean, there's so many questions because the market, like COVID, has had this incredible shock to our system, to the whole world, really. But you just look at the property market. I mean, I was predicting a big crash, and I was saying it's always delayed and all this, and here we are looking at prices like running away with us. And I'm trying to get my head around, what is it? Is it demand, or is it the risk of inflation, or what do you think are the kind of drivers that are kind of pushing prices up the way they are?
That is the $1 million question. That one,
$1 billion question.
So yeah, exactly. So casting my mind back 18 months ago, I was sat here in this office, and I was looking at the data, and I was thinking, I cannot see any indication that property prices are going to fall, even though all of the industry, all of the media, even the the banks were all saying it. You know, they were pulling out, thinking about pulling products and all that sort of stuff that was going on. And I'm sat here looking at my report suggesting it's going to be an uplift in values, and it was a scary moment for me, because I thought, if I say that and it doesn't happen, I'm done. But I did it. I thought, no, I'm gonna be guided by the data, which is a term that's used far too much at the moment. But I was going to be guided by it, and I published. And I said the market's going to increase, and it's going to increase at a more rapid pace as we move through 2020. And that was proven right, which was great for me. It improved my standing and the respect for me. But most people assumed that the market would fall. Now, the reason the market wasn't going to fall and didn't fall is because there are some very specific mechanics in most property markets that determine whether or not it will grow or it won't. And one of the key determinants is availability of stock. And I saw availability of stock falling off a cliff
because
people were not listing their properties.
Yeah.
Properties couldn't get refurbed, developments weren't getting done. So we had, if you imagine you've got a shop full of stock, if you imagine if you're a retailer and you sell out of all your stock, doesn't matter what's going on around you, the next time you get a delivery, everybody's going to want that stock. Yeah. So if I run out of milk in my supermarket and I don't have milk for a couple of days, and then I open my doors back up again and go, oh, I've got milk now, it'll fly out the door. Everyone will panic by it. We saw it with toilet rolls.
Yeah, that's a very good point. Yeah, it's funny. A lot of people didn't predict that aspect. I saw the furlough schemes, and I saw all of the kind of the unemployment that was happening and the businesses shutting down as the main driver for kind of a massive crash. But you say
it's a convenient description. It's a convenient because it sounds we're predisposed to do this. We look for solutions as human beings. We look for the simplest solution to a problem, the easiest explanation. And the easy one was, oh, well, actually, we've got this new thing happening. That must be the reason why it's safe. So, I mean, the other one was in the United Kingdom. We had stamp duty holidays. We didn't have them all over the United Kingdom. We certainly didn't have them for second homes in Wales. So there was people standing up on stage going, oh, once this goes, the market's going to fall. Well, as we sit here today, the fastest growing location for property prices in the United Kingdom is Wales, and Wales hasn't had a second home stamp duty holiday, so we can actually throw that one in the bin because it's not the reason. There was, going back to the question about why hasn't the market crashed and why is it not likely to crash. I can kind of answer that with some research that I've been working on for years, and that's about the availability of credit and the availability particularly of property credit or property finance over the past 30 or 40 years, and where that availability is restricted, that causes a reduction in house prices, and where the availability of credit is increased across the board now, not just on property, but property is part of it. But when availability of credit and credit rule relaxation is encountered, or interest rates are reasonable, those sorts of things, that causes markets to grow. So we've mentioned furlough. That's an element of credit. We've had business interruption loan schemes. We've got. I couldn't dream of going to the bank 3 years ago and ask them to give me some money. They would tell me to go away. Now they can't stop sending me letters, offering me money at a cheap rate. So we're in a credit change, which also drives values in upwards. So both we've actually got two pretty powerful sort of levers that are in the machine that are causing an increase in property demand. There are several others, and they're really the main ones. But I like to try and keep things as simple as I can, so I'm not going to go into any more detail on
I mean,
on the background.
It's fascinating, though, just to think that you could see this in the data, and so many of the commentators out there were kind of saying the complete opposite. And well, we must get into some of the specifics. I mean, for example, like you've got Zoopla here in Ireland. We've got we've got different websites, obviously, like we've got one called Daft and stuff. So do you use these kind of portals to kind of harvest the information and the data that you're talking about?
Yeah, I mean, there are some aggregation tools that are out there at the moment that enable you to, if you've got multiple sites, you can sort of aggregate them all down into one. I do a combination of getting the data direct from those sites, using aggregation tools. I also use a lot of government published data as well. Key one is also, I didn't mention a moment ago, is affordability. I ask myself the question: is an area affordable when I'm investing as well? Because if it's a very affordable area, average household incomes are growing, and then that really helps too. So yeah, depending on where you're investing, will depend on what data you look at. But the specific, getting back to specific data, not necessarily the names or sources of data, we want to look at demand, and we want to look at the relative affordability of property. So, a good example at the moment is property. The media loves to hype up how expensive property is now, how unaffordable it is. And I look at the cost of service and that debt that you take against the property. And the cost of service and that debt is the lowest it's been in the United Kingdom since 1978.
Yeah, actually, it's funny you say that.
Property.
We've got something similar here in Dublin where you can rent a property or you can buy it, and servicing the loan is actually less than the rent. And it wasn't always like that. And so it's come to the point where you're kind of like seen as foolish if you're renting. Why aren't you buying, just paying down the mortgage? Because it's cheaper than the rent that you're paying. So it's and so that's kind of, and how do you find those? I mean, in terms of a specific example, do you compare, month to month, or so that's what you do? So you can kind of
So I do everything. I do the whole of the United Kingdom, and I do some other locations as well. Doesn't matter where I'm doing it. What I want is to understand the market and what the market looks like. We talked about rents a moment ago. People always say, well, why don't you look at house prices, John? And it's because I want the freshest, most up-to-date data I can get my hands on. So if I don't know, where I'm sat here now in Wales, if there's suddenly a large employer open up nearby, and they create a couple of thousand jobs, I want to be able to see that. I want to be able to know that. Now, it's not always possible if you don't live in the location, or you're not fully up to speed on a location, and you haven't got access to plan and all of the complex stuff that we all try and do. So I just simply go, all right, if something's going to happen, if that factory's open up in here, it's going to create a demand for housing. Where am I going to see that demand first? I'm certainly not going to see it in the property purchase market, because it generally takes 3 to 6 months to get a property purchase through all of the the legals and stuff. But if I want to rent a house, I can probably do that in about 4 to 6 weeks. So if I see a spike in demand in rent, I can pretty much confidently say that I'm likely to see a spike in house prices at a later stage. And that's really important right now at the moment with all of the change that's going on everywhere, people working from home, offices closing, and giving people the opportunity to work from home. People are just making different life choices and different decisions as to where they want to live. And nobody knows where people are going to want to move to or where they're going to live. It's just too complex a set of data to unpick. But if you can see where the demand is starting to spike, you can get a good indication of where house prices are likely to go. So if rents are increasing quickly because people can move more quickly, then house prices are likely to follow. So I would encourage everyone to start doing that if you're not already. Stop looking at house prices, because that's what the media loves to publish and talk about, and we all get excited about. But start looking at rent demand, because that's the quickest it's a piece of insight you can get into a sort of a residential market. It also helps with commercial as well, because if you're looking to invest in land, or you're looking to invest in retail sites, again, you're going to want to see that the population is what's changing in the demographics of the population as well. If the rental market is mostly HMOs or small units, small cheap units, then you're probably not going to want a high end, very expensive retail operation. If it's more 3-4 bedroom, larger properties, luxury apartments, that sort of stuff, then you might have a different thought. So getting that data to hand, and it's not hard to get at. You can go on a search portal, list all the rents, make a note of the average for a postcode area for a property type, and then compare it the following month. That's all you need to do. But very few people do it.
So, John, when did you sort of come across this? Was your first investment very, very kind of carefully made, or did you kind of like some of us make mistakes in our first few deals? Did you sort of do all of this data analysis and kind of carefully select exactly?
I was terrified, Gavin. I was terrified. I was really scared. And I think most of us, it's not popular. We all like to talk about how great everything is and how wonderful it'll all work. But that's not me. I was sat there in my office, in my day job, my corporate job, absolutely terrified. What am I doing here? Why am I doing this? This is risky. All right. I just wanted to be. It was around about just after the credit crunch, so it was. I dabbled in the past with some property in the early 2000s, but this was me taking it seriously and wanting to build a portfolio, and I was absolutely terrified of losing my money. I couldn't afford to lose the money. It was my savings. It was my life savings, and it wasn't a lot. It was a relatively small amount of money. So I wanted to make sure that if I put that money in, and what I'm actually doing is I'm leveraging that money, trying to get higher returns, but also that leverage can work in the opposite way. It can also cause a higher loss. I wanted to be sure that the property was going to go up in value, even though I was going to rent it out and I was going to get cash flow from renting it out, a basic buy-to-let property. I wanted to make sure that that property would increase in value. So I wanted to invest in a location and a property type that had a high probability of increasing in value in a difficult market. And that research enabled me to invest in a particular market. I bought one house. I then did another house. I then did another house, and I was recycling that money each time. So I know a lot of us will be aware of that type of strategy where you buy, you refurb, and you refinance.
Yeah, the BR.
I added, but I added another element, another dimension to it, which is buy, refurb, refinance, and let the market make me money.
Yeah.
So just like investing in shares, like investing in currencies, I wanted the market to work for me. And I quickly learned that it was a hell of a lot easier to allow a market to do the work for you than to pick up the building equipment and the building materials and the tools and have to go do that and be completely dependent upon that. So as time went on, I then just grew my portfolio by taking a very similar approach and investing in different locations out of my comfort zone a little bit, relatively local to me initially, but out of my comfort zone, places I thought I wouldn't buy there. I'd never buy there. That can't work. But that was the emotional side. It wasn't the logical side of my head that was working there. When I put the logic into it, and I could say, oh, actually, take my biases away. Let's just go and invest. And I made really good returns by doing that.
That's great to hear that, because one of the things that I kind of, I suppose, preach is the kind of the importance of knowing your emotional sort of attachments to a project or a deal or something like that, and you can allow your emotions to talk you into something that you shouldn't do, and then equally, like you're just describing there, that your emotion can talk you out of it, and you can think, oh geez, I don't know, my gut instinct tells me not to do this, but the data tells you a different story, and you should sometimes just trust the data.
The problem with the emotional side is it's really loud and it's really powerful, and it sort of can dominate. So when it's shouting at you, and it's also fast as well. The emotional response is much faster than the logical response. So the emotion's got all of the noise, all of the power, all of that, and it's also really quick. So it just goes, don't do that, and you just got to take a step back sometimes. It's like last year when the coronavirus hit, everyone was really emotional. We'd been locked down, we were stressed, there was the unknown, and the emotional was, I think this is going to happen. This is what I think will happen. This is what I think. Well, whenever I hear I think, I immediately just sort of recall and go, okay, show me you working out. Why do you think that? And when you unpick that, you sometimes can find there's nothing behind it. So yeah, that's you've hit a nerve there with me. Logic first.
2-bedroom, 3-bedroom, 4-bedroom. I mean, is that clear in the data as well?
Yeah, you can separate. And frankly, the most important thing right now is understanding what property type works in what location. Because I mean, I'm not going to pick on any one location because there are several. But I get people come to me and they say, so and so had a really good result in that city. They've made a killing. They made however many hundreds of thousands of pounds, and they did really good. And I'm gonna follow the same strategy. And I immediately just sort of can feel my head dropping into my hands, just thinking, okay, let's unpick that. So the person's already made the money, so that was a long time ago. Property is moving very quickly at the moment. Also, you haven't done any research, you're just following someone. You're going to invest hundreds of thousands of pounds of your own money, and you're going to invest loads of your own time with no insight into whether or not that area has already been through a growth cycle and has leveled off, or if it's actually going to go into decline. And do you really trust the person? How well do you know him? How the person that you've spoken to, all that sort of stuff.
Yeah.
Just drives me mad. So you've got to be able to understand the type of property that is going to perform best in the locations where it's likely to perform best. So I buy 4-bedroom properties and I rent them out, and I have HMOs and I rent them out. I wouldn't dream of having my 4-bedroom standard single let properties where I've got my HMOs, and I wouldn't dream of having my HMOs where I've got my 4-bedroom single let properties.
And what about apartments? Does that feature in your portfolio?
Yes, I do. I'm actually developing some at the moment. So that's that's part of what I do. I mean, I've got quite a diverse portfolio now, sort of HMO, single let, and some sort of retail-y, office-y type stuff as well. Do a bit of land. The honest truth is, in all of this, is it totally depends. You can have a strategy, that's great, but it totally depends on whether it'll work in a location. So I always go back to when people say, I'm going to buy HMOs for cash flow, or I'm going to do ground up development. I go, well, that's great, but what areas have we identified where that outperforms the other options in the market? Because what's the point in doing something that doesn't work as well as a different type of product or a different type of property in an area? So my portfolio is diverse because my portfolio is very, very specific to the needs of the location where I'm investing. So apartments. There are apartments being thrown up in some cities. There's far too much supply. There's one city which I'm very familiar with where we've increased the HMO stock, the room stock, by 42%, and the role of the attendance role of the university has dropped 14.
Wow, yeah.
What a mistake. And that's not just down to us, that's down to planning, it's down to authorities, there's many things. But do you want to play in that market? I don't want to play in that market. I'd much rather go down the road and get a better return somewhere else.
It's a difficult one because it's. I was looking here in the Irish market. Student accommodation was the hot asset. Everyone was piling into it. All of the big kind of international student funds and stuff were piling in, and I would say everyone's kind of licking their wounds after the last 12 months because most of the students have all gone back home, and international students as well. So it's.
Well, I suppose the question is, how many of those people who have invested into the student market have actually taken the time to get the student roll numbers from the universities local to those properties and considered, is it going up or down? Because again, it's just demand. If the demand, if don't get me wrong, if the university's got an increase in roll and it's investing and all that, brilliant. Fill your boots, invest. But if it's not, and a lot of them aren't. Why would you play in that market? It's like buying bread in that shop that I just mentioned, where we're not a milk. I'd rather be the milk supplier than the bread supplier. Just do something else. But that's the reason why the market, a lot of the property market is broken. Is because we don't, as an industry, match supply with demand, and that's a fundamental failure of the whole market. It's the reason why it gets itself into a bit of a mess, is because we just don't react quickly enough to change, and now data helps you to do that.
Yeah, it's a very good point. With some of the data that I'm hearing, so it's not data, so to speak, but there's a lot of talk about the big cities and the big kind of areas where main employers are based, that there's a drop off in properties there, and that people are kind of buying in the countryside and rural areas, and that they're trying to, that they're thinking that work from home and remote work and all that is going to be possible. Are you seeing that in your data?
In some locations, yes, not everywhere, and it's not. I don't think it's a convenient answer to a more complex question. What we're actually seeing is a rebalancing of the property market affordability. In my view, it's a catalyst for opening people's eyes. The other thing, and this is really important for everyone that's investing in the UK at the moment, is to understand the impact of the 95% or above loan to value mortgage. Because the challenge that there has always been is the inability of, it's not that people can't afford to service the debt when they take on a mortgage and own their own property. It's the barrier to enter in that market. That barrier has been pretty much, it's certainly lowered. It's almost removed now. So I am seeing in my data quite a lot, an awful lot of activity at the lower end of the market. And that activity is predominantly driven by first-time buyers and people looking to get on a housing ladder. That's very interesting because that could have two specific impacts. One, it could cause a slight slowdown in rent, but I'm not seeing that. Two, it provides liquidity to the property market, which enables people to move up the ladder, down the ladder, across different locations. But that it's very specific to certain locations and certain cities, and the reason for that we can try and unpick, but we'll still be here in 4 months' time. It'll be too late. We just need to understand that it's happening. We need to look at where that demand is occurring and act upon it. So when I say looking at rent as one element, there are also other data sets that we can look at too. But a shameless plug. Yeah, I do help people and teach people to do that. So
Yeah.
if anyone wants to learn about it, I'm more than happy to help.
Yeah, I'm going to put links in the show notes to your website and stuff like that.
Thank you.
I was going to ask I mean, that's actually interesting what you say about the banking and the 95%, because the Irish economy went through such a shock after the 2008 crash that they've done away with all that. And they actually made it at one stage, it was 20% deposit was the minimum that you could have in order to get into the market. And of course, 20% on an average house price of like 400,000, that means that, you know, your average couple have to save up 80,000, and that is not an easy thing to do. And, you know, you got to get parents to help you out and all that kind of stuff. And it has a big impact on the market. And it means that there's a lot more people living at home with their parents much later than they would, or else, you know, obviously renting for much, much longer than they previously would have. So it's interesting how it's all popping up. We were just talking about your website there. I mean, mentors, the importance of them, and you know, the so-called gurus that are out there. Give us your views on all of that.
Oh dear. Oh gosh, it's a bit broken, isn't it? A lot of what happens in our industry. I mean, you know, hands up. I provide education. I provide support services. I do provide mentoring, but I prefer to refer to it more as consultation. I'm a business consultant. Now, if you're a property investor, sorry, it's not passive. You are active. Don't believe in passive income. You're an active property investor. You're running a business. If you're running a business, you need to have insight as part of that business. And sometimes you need an element of consultative services as well. So I offer a bit of consultancy. Do I like all of the get rich quick stuff? Absolutely not. It drives me bonkers. It's an emotional sell, really, isn't it? I mean, we talk about mindset and, you know, well, look how rich you can become and how much money you can make, and, you know, it's really easy. Everybody wins. Well, they don't. I know of a lot of people that have lost. I know of a lot of people that have made some pretty poor decisions. They've stagnated or stopped. You know, it isn't all glamour and excitement. It's hard work, and you've got to put that hard work in. But if you do it right and you do it in a disciplined and structured way, and you've got facts and evidence rather than emotional stuff and opinions and blah blah blah, I think it's a fantastic industry to be in, and a very, very exciting time as well. But do I like mentors? Gosh, you do need a mentor in business. I think everybody does. What I would say is, you know, think about what you want to get from your mentor. You know, have you shared your business plan with them? If you haven't got a business plan and your mentor is mentoring you, I would have a bit of a question.
I also think the motivation of the mentor is important, because there's guys that are just trying to kind of have as many students, I guess you could call them, or mentees on their kind of payroll as possible, so that they're making the maximum. But, you know, there's a quality that comes with, you know, the number that you take on at a time. And if you take on, you know, 50, 60, 100, you know, students, it's very hard to kind of service that if it's just you providing the service. Whereas, you know, a kind of select group would be probably my preference anyway.
Yeah, I mean, in my mentoring side of my business, is a very small part. We have a maximum rule of 12, so there's no more than 12, because, you know, as you rightly point out there, can I offer value to more than 12 people? No. So I'm not, you have to wait till someone finishes their consultation with me before there's a place comes up and you can join. So, you know, that I completely agree with you on that. You know, these farms that just farm out mentoring and training. And, you know, sometimes I encounter people who've got mentors who don't even own property. You know, they don't. They're just been through a training course. Oh, I'm a property sourcer, and I'm going to do this. And I just think, you know, I used to work with large multinational companies. I provided consultative services through data to massive brands around the world, and you know, and I just think, you know, I know the amount of effort and time I had to put into that, and I also know that if what I provided them didn't work, they could move on, use someone else, but it also would have a fundamental impact on their business. When you're talking about someone who's leveraging themselves sort of 3 or 4 times the amount of money that they put in, and all of the money that they put in is you know, their future, their life, I think that's a significant responsibility, and it's a significant risk for you. If you're giving someone money and they're giving you what is in essence advice and support, and it's the wrong advice and support, or it's not relevant to you, then I'd find that phenomenal. I hate the term, take action immediately, do it now, make it work. That's a popular one. Make it work. No, you don't make a deal work. If a deal doesn't work, a deal doesn't work. You just say no and you move on. I see people sat there trying to make strategies work in locations where they don't work, and I have to step in and go, right, I'll pick up the pieces here and we'll put it back together properly so that it works properly. We'll start off with, what the hell are you doing?
Yeah.
Why are you doing it that way?
Trying to force a round peg into a square hole kind of a thing, yeah.
And you must see it, Gavin. I mean, I'm sure you encounter it regularly. Just the absolute mess that is created sometimes by some people. But run Ev again. So I'll shut up on that one.
John, I just want to give you your book a plug. So, Property, Truth or Dare, the truth about property investing and the risks of daring to take part in the property industry. What motivated you to go and write a book with all of this? It's a great piece of work, by the way. I was going through it there, and you've got the glossary, all of the terminology, and then the data points and stuff like that. I mean, how much work putting that book together did it take? Is that your whole process kind of filled onto paper?
It's basically it's a bit of fun. It's sort of poking a finger at some of the stuff that goes on in our industry and just opening everyone's eyes to, like, come on, let's be more professional. Every book that I encountered was like, don't worry, you can make millions. Don't worry, you can make millions. Don't worry, you can make millions. Don't worry. I thought, there isn't a book that says, don't worry. There isn't a book that says, be aware you could lose. So I thought, well, let's come at this from a different approach. Let's say, right, you can make really good returns, do really well in property, but there are also risks involved as well. And I want to talk to you about the risks and how to avoid those risks. So that's really why I just thought it would be much more interesting to have a book that talks about the good and the bad, and you can determine where you are on that scale.
And that's spectrum, yeah.
Yeah, and I really enjoy, I mean, it took me forever to write, Gavin. I'm not a publisher. I'm not a true sort of author in the truest sense of it. I'm not going to have a catalogue of a dozen
selling books.
But I just wanted to share my view. I mean, I'm a down to earth, normal sort of guy. I just want to spend time with my family and help my community and people around me. And I just thought it was about time somebody just wrote something honest about the property industry, because I felt not all books are dishonest, I'm not suggesting that, but I found it difficult to find a resource that helped me to understand how to avoid risk. And that's where I come at all my investments. First and foremost, I must avoid the risk. Once I've avoided the risk, then I can focus on the maximum return.
Or if not avoid the risk, at least mitigate it as best as possible.
Mitigate or avoid, definitely. Yeah. I mean, there's always risk in everything that we do, but you can look at the probability and the scale of that risk. So that again, I'm not going to spoil anything. I want people to read the book, really. In talking of risk, again, for people who listen to this today, if they want a copy of the book, I can do a free copy. Just the postage and packaging is all you've got to pay for. I'll make sure that there's details for everybody.
Okay, I'll put it on my on the show notes. But that's very nice of you. Yeah, I'll put it in the show notes. That was one of my questions, was where can they find the book? Is it on Amazon or is
it's on Amazon. You've got a choice. You can pay £17.99, or you can pay £15.99, or you can get it for free and just pay for the postage, which I think is about £5. So it'd be better to use the link that you put on.
Yeah. Okay, we'll do that, John.
Less risk.
And John, you're the best place to find you if people want to reach out to to learn more about your education and your training courses and stuff like that. What's the best place?
Website's fine. So that's ultimate-landlord.com. You can also join our Facebook group if you want to. That's just Google Ultimate Landlord, Facebook, and you'll find our group.
What's it called? Ultimate Landlord.
Ultimate Landlord group
on Facebook. Okay.
On Facebook, or you can go to our website. We do publish a lot of the stuff that we do. We do here, and we give away freely. So I'm not a pyramid scheme that's going to sell through lots of different levels of you. If you want the latest property market read, for example, that's free. That's education1.ultimate-landlord.com, or you just go to our website and you'll find it, and that'll just tell you what's happening in the market at the moment, where are the affordable areas of the UK, what we forecast is going to happen next. we've published. We're on to our 4th version of that now. The previous 3 were very accurate, and we forecast a surge in property values Q1 this year. We forecast the growth Q4 last year. So we've got a bit of a good track record. But I mean, I'm not suggesting for one moment that you have to take everything I say as true, because I will actually teach you not to do that and do your own homework.
Yeah.
But in terms of a whole market, it's really interesting, and the market is. There's still people going around, Gavin, saying, "Oh, the market's just about to fall off a cliff. It's going to crash. Save your money, sell your houses, and all that." And it's just depending on where and what you buy in, that might be true and it might not.
Yeah.
I'll just help you to answer that question properly
with the data. Yeah. Okay.
Yeah.
Well, John, thanks so much. I'm conscious of our time today, and I wish you the best of luck. And I hope that some of our listeners will seek you out and start kind of taking some of this stuff on board.
Hopefully, we'll get back to whatever normal used to be, and we'll actually all get to meet up in person. I really look forward to seeing people in person in the near future as well. I am very hopeful that we're coming to the end of a very difficult time for everybody, and huge opportunity for us all to engage, network, learn from one another, and do well. So if I can help with any on anyone's journey, I'd be delighted to, and I really look forward to seeing everybody very soon in person.
Amen, brother.
Thank you.
All right, John, thanks so much for your time today, and we'll catch up in the next one.
Look forward to it.
All right, guys, I hope you enjoyed that conversation with John. I think it's definitely an approach you need to add to your list of things that you do when you're looking at buying a property. Get into the data analysis. It's super important. So look, that's all for episode 58 of Behind the Facade. Thank you so much for listening. As always, my number one ask is for you to leave a review or simply share the episode with someone you think would benefit from it. In the show notes, you're going to find links to all of the things discussed today and to John's free book and his next workshop. And if you have any questions or topics you would like me to cover in future episodes, or indeed guests who you think I should talk with, please let me know in the Facebook group Behind the Facade community. Alternatively, you can find me on social media. The handle, as always, Gavin J. Gallagher, and that goes for the YouTube channel that I'm plugging continuously these days. Lastly, you can stay up to date with events, and in particular the mastermind launch that's coming soon, and just by adding your name to the email list, and you'll find that at www.gavinjgallagher.com/go. All right, guys, it's been a little bit shorter than normal this week, and I hope that allows you to get back to work, and look forward to seeing you again next week.